So it's a big swing business. Venture capital, there are many different ways to build a business. There are many ways to build a venture-backed business. I decided if I was going to take venture capital again, that I wasn't quite satisfied with the swing I took last time.
Hello, this is Shawn Budde of Ensemble X, and this is the Ensemble X Exchange podcast. Today I'm talking with Derek Flanzraich about his former startup, Ness. What went right, what went wrong, and what lessons came from the experience. Derek is passionate about making health accessible and affordable for everyone, creating the largest health and wellness media site, Greatest, which was acquired by Healthline Red Ventures in 2019. With 10 to 20 million visitors each month, Greatest offers shareable, fact-checked content to empower people to make informed decisions. Derek also created a health-based credit card, Ness, in 2021, and today he consults for companies like MIDI Health and NoCD. Derek is an active venture partner and sits on the board of Stoked, a nonprofit adventure sports mentorship program for underprivileged youths. Thanks for joining me today, Derek.
You bet. Thanks for having me.
So we first talked to you about Ness about 3 years ago, and I know this was very personal for you. You had your own journey to a healthier lifestyle, so I'd love to hear a little bit about that before we dive in.
Yeah, absolutely. And thanks for asking. Yes, I feel very blessed to have found my deep personal and professional passion for making health more accessible early on in my life. And it really stemmed from and started from my personal experience growing up a really big kid, struggling with my weight. When I was nine or so years old, I had an accident with my hand and ended up with my right arm in a cast for 4 years, 3 surgeries over 4 years. And so with my right arm in a cast, I'm right-handed. So when most guys play sports and make friends, I did neither. I ended up reading instead, which I guess, probably paid off better in the end, maybe. But I just kind of felt very different and also drank 6 Dr. Peppers a day. And then when my family moved to Miami, Florida, I was suddenly surrounded by all these sexy people with their shirts off. And I was definitely far from sexy. And I became very passionate about trying to figure out how to become healthier and struggling and frustrated with kind of the information that was out there and the people who, we turned to. I started reading all these scientific studies on PubMed because I would, obviously very fun at parties, as you can guess. And I started reading all these scientific studies. I learned a lot and I started to get better. I started to share that information with my friends. And I learned that sharing information as sort of a friend that was a little further along was oftentimes much more impactful and much more influential than, someone who has it all figured out already. And so that's what really carried me into my first startup years later, was really I want to build the media and content that I wished existed growing up. Greatest, we built into this massive health and wellness media company. And I really cut my teeth there in terms of becoming a leader and a business builder. I mean, I started the business when I was 22, sold it when I was 30 years old, after 8, kind of crazy, amazing years. And that's a good time for you to ask, am I still very deeply passionate about this mission that we went about trying to solve? Greatest was really about talking about health in that same way, this friend that's a little further along. I think we were really on the cutting edge of sort of talking about having science-backed, expert-approved content that was worth reading and that you would want to share with your friends. And the answer was yes. I feel we just scratched the surface of what was possible. And that's really what drove me to Ness.
That's a fantastic story. I appreciate that. So why don't you make that connection for me? What is it that drove you then to start Ness? And actually, I guess before we do that, why don't you just describe Ness for us so we all know what we're talking about?
Yeah, sure. Our Greatest, it was about shaping the narrative around health and wellness and making it more accessible. But we kept running into this issue that no matter how friendly and accessible you make health and wellness, the reality is a lot of it is very expensive. For the average person, it can feel, and frankly, if we're being honest, it is really expensive to try and keep up with the trends, to try and be healthy. We used to try to make the case that you could, shop at the store, and if you bought brown rice in bulk, it would be cheaper than buying Kit Kats. But the reality is that's not true. And it really came down to cost. And so I kind of went down a rabbit hole, becoming obsessed with this notion of who actually wants to reduce cost when it comes to your health and wellness. Who's actually aligned and incentivized? It drove me to, one like real frustration that I have with healthcare, which is the way it was built over time and in some ways like deepened since then. Most people stay on a health insurance plan for a very short period of time because health insurance in our country, unlike almost any other country in the world, is tied to employment. So that is like a very odd thing that like the average person stays on a health insurance plan for 2 to 3 years. And it makes sense actually why most health insurance plans don't care then about your long-term health. It's not that they're bad people. It's that there's no financial incentive for them to care. And actually, frankly, them investing in your long-term health probably is going to help out a competitor because you're going to switch to a different plan.
Right.
This is very frustrating, frankly, like infuriating, right? That like the things that we all agree and know are good for you, healthy food, working out, all of it, blood tests, all these things are expensive and most people have to pay for out of pocket because of like the way the system is set up. So one of the sort of like insights that started to drive me towards starting Ness was realizing that, yes, like in theory, long-term, you could align those incentives. But there are people who do actually care about reducing, the cost of health and wellness so that more people can access that. And one of them is employers, right? One of them is like who's employing you. And the second one is the brands that are actually selling this stuff. That felt like a very kind of big breakthrough. It was an experience we'd had at Greatest where we were selling to all of these big brands, whether it was RX Bar or, any kind of like, whether it's healthy food or fitness brand. They were spending a ton of money to try and get in front of people. And so as we started to work on what the vision, became, we're going to build the next Amex. We're going to build it health first. And we're going to create a whole suite of cards. These cards will reward people for spending on healthy things and for doing healthy things with points they can basically use to do more healthy things. And the way we would be able to accomplish that is take what turns out to be a tremendously high margin business in health and wellness, turn to the brands themselves, ask them to take the money they're spending on acquisition and return that in the form of value to our members. So the math was pretty compelling. It meant we would have nearly no cost, almost entirely merchant funded rewards, which turned out to be true with our first card that we launched early last year. And the bang for your buck for the consumer was going to be also tremendously high and even higher than you can get on almost any card in the market. And so this felt, putting aside also the like goodness of that, like lovely, positive, like cycle, the business model felt really compelling. And the opportunity to capture, frankly, consumer spend in health, we got very, very excited about.
Yeah. So I assume the name came from goodness and wellness, not Loch Ness.
That's right. That's true. Though it was Loch Ness inspired. So, the website was Ness Well, so wellness flipped. So that's where it came from. But I love Scotland for some reason. And I thought it'd be fun to have like the Loch Ness as a mascot. And so it ended up being kind of a subtle reference. And if you had one of our cards, which actually I keep with me, here it is. That's the end, but it's also like a subtle Loch Ness.
It's a little play.
Yeah. Exactly.
Very nice. Yeah. I mean, it's an interesting insight on healthcare. I didn't realize the duration that people had on a plan was that short. Every year when we get our healthcare plan, we're just happy it hasn't gone up 20%. We're pretty excited if it's only gone up 10%.
Yeah.
So why don't we talk about the creation of Ness? How did you meet your co-founders and how did your interests and your skills kind of mesh together? Where did you fit together?
Yeah. So it's worth sharing, transparently that I had no fintech experience at all. Now, that doesn't typically scare me. Maybe it should have, looking back more than it did. But that typically doesn't scare me, I feel like I can figure out most things and that there's actually a lot of value in having like an outsider perspective. But I was also like deeply aware that I needed to build a team of people who really knew fintech. And with just kind of a vision in my hand, I went out to people that I had met before and asked them to try and collect like a who's who in some ways of people who really knew fintech to figure out how to build like the credit card company of the future. And pretty quickly, we had convinced people who had worked at Stripe, at Amex, on the Apple Card, to come on board. And I think at some point we had basically every major consumer card launch of the last 10 years. We had someone at those cards involved with the business in some way, whether it's an advisor or as a full-time team member. And we took a crash course in like learning a lot about fintech in a very short period of time. we learned enough that really we were able to convince a bunch of smart fintech investors to actually like invest in us. And I want to flag that this was in 2020, which was a very different time in the financial markets. That comes up later because there were many more interesting times to come. That comes later in the story. But at least at that point, second-time founder who'd been pretty successful with his first business, the very big, ambitious vision. Venture capital loves Bill saying we're going to build the next Amex is very compelling, especially in health and healthcare.
Yep.
The vision was very clear, and the long-term vision was very exciting. You could really see how that becomes a multi-billion-dollar business. That's what the VCs want to see. We raised a lot of money, probably not enough. Honestly, looking back, but we raised a lot of money, about 25 million or so, almost all out of the gates, and put that into building an amazing credit card platform with a very different kind of approach than most people took to building credit cards at the time, and maybe today, which was we're not going to just try to get a credit card out. We want to build a platform for like the long term, right? So we can collect the most upside in terms of revenue, so we can own the experience from top to bottom, so we can build out our own network of merchants. The vision was we're going to build this big consumer credit card company, not we're going to build a credit card. And so we decided to take a lot of made a lot of longer term decisions, which was a decision at the time. It was definitely an approach to take.
Yeah, I actually don't think you're that unusual. I typically say that 90% of fintechs are 100% tech. We've seen some research out of Europe that actually endorsed that. What maybe distinguishes you a little bit is that you went and sought people who understood financial services. I think we see plenty of organizations, some successful, some not, that don't bother to do that.
I mean, that's crazy, right? I mean, that doesn't make any sense to me. I think maybe it was from, the experience of my first company. I mean, I learned a lot. I learned a lot at Ness, and I still have a lot to learn. But for sure at Greatest, one of my biggest learnings was how important it is to be willing and able to ask for help, and how critical it was to build a sort of advisory board and a sounding board of people who really knew the space deeply, who could gut check, what you were doing. And again, I think we got much further than many companies do, in no small part because we had really the best of the best, advising us and helping us along the way.
Yeah, I would agree with that. And I think sometimes maybe the challenge is finding people who understand the industry but aren't stuck in what the industry has been doing, right? So they're open to change, but they're also able to learn from the past and share those learnings.
That's true.
So you talked a little bit about, taking kind of the grand vision here. What were your expectations when you, in 2021, when you raised 2020?
Yeah, basically 2021.
Versus what ultimately happened.
So it's a big swing business. Venture capital, there are many different ways to build a business. There are many ways to build a venture-backed business. I decided if I was going to take venture capital again, that I wasn't quite satisfied with the swing I took last time. With Greatest, we built a good business. We basically were an ad-based media company. We tried to do a lot of more interesting things, but kind of the gravity and weight of this business that was working, that cost about as much to run as we made from, the business, made it very hard to turn into something that was truly venture scale. And we kind of got stuck, I guess, is the way to think about it. Now, again, you look outside and in many ways it was very successful, but in other ways it was definitely nowhere near as successful as I had hoped it would be. Because we basically turned into a media business and sold as a media business for a multiple-ish on our revenue,
Sure.
I didn't want to do that again. And I wanted to take a very big swing. And I was very honest with all my investors, with everyone involved, that we're going, shooting for the moon here. And that colored a lot of our decision-making. We knew that there was no world in which raising 25 million was going to be enough. And our plan was to raise 50 to 100 million, not long after, and raise until we had basically reached critical mass where we were generating enough money from, credit card members that it could become a profitable business, whether that became through, building a deeper relationship with an existing bank, or whether that was, having enough revenue that we could like basically move the rails to somebody else, much like Built has done. The math just doesn't make sense in the early days of a credit card company because you're paying so much money in interest to borrow the money to front all these people for 45 to 60 days.
Yes.
It's just a capital intensive fintech business if you're doing it on your own. And that was something investors were excited about in 2021. And a year later, with like fintech kind of imploding, frankly, all the venture markets shifting and changing. I mean, like very much a venture capital winter, but also in particular for fintech, also healthcare companies were beaten up too. And we ended up trapped. I mean, basically, right? Everyone was like, well, this business doesn't work yet. And we were like, yeah, well, we never told you it would work by now. and we actually launched a card early last year, our premium card that I showed you earlier. We launched it with, Sweetgreen as our anchor partner, Parsley, Prenuvo, Seed Health, Exhale Spa, really like an amazing assortment of partners, about $3,000 to $4,000 in benefits to the end consumer. Almost none of which we paid anything for. Pretty extraordinary returns on any health and wellness spend. We did a lot of amazing things, honestly, and people loved that card. And actually, basically every number we had hoped to reach, outside of kind of like the total membership, we had hoped we would reach a lot more members, but it's hard to sell a credit card. All the like actual usage and engagement of the card were like off the charts, but it was never intended for that premium first card to be the business. Right. It was always the beginning to build the brand, to build the relationships so that we could launch another card. We were working on a no annual fee card that was due to come out late last year that would have, I think, really changed the game. And we just never made it there. I
mean, you hit on it. It is an extraordinarily capital intensive business. I mean, we have launched a credit card business and it has great CAC, acquisition costs. And even so, we think we're going to have to raise on the order of $300 million. If the CAC isn't great, you're probably at $500 million. I think a lot of people don't expect it to be nearly that expensive when they get started.
Yeah. And look, at scale, they make money, right? These are great businesses. Cards essentially, to my knowledge, are among the most profitable revenue streams at most of these banks. The problem is you're not a bank yet when you're a startup.
Right.
And that means you're borrowing essentially with a bank. Most people I know who've started a credit card company in the last few years have ultimately done it on a credit card as a service solution.
Yep.
The solution being a Deserve or a Bond or whoever it is, Lithic. And that is no way to build like a good, profitable business, but it's definitely a lower risk way to get a product out there and start proving something out.
Yeah.
We decided to build a relationship, went out and got our own bank BIN sponsor. We decided to create our entire app from scratch. We decided to do all the customer service, again, all these decisions, we didn't do everything, but most things we did because we wanted to own the experience end to end. And again, the vision was very big. I believe ultimately you do want to be planning for the success of this, but come early 2023, all those decisions started to seem kind of silly as the timing had shifted so much. Suddenly we had made a lot of calls to invest in a thing that was not fundable anymore.
Right.
And so we had to ask ourselves some really hard questions around what could this business become? And was there really a there still? And it was a tough time.
Yeah. So I want to come to that in a second. But first, I'm super curious how you go and get Sweetgreen and other folks to sign up when you have, I assume, round numbers, 0 customers.
Yeah. You have to be very charming. No, I think...
There's my weakness.
I haven't seen that. I think the short answer is you have to have a good pitch. The reality is, as long as you're pitching to someone who's actively trying to acquire the customers that you intend to get in front of too,
mm-hmm.
and you intend to put a lot of time and resources and money into trying to reach those customers, it's kind of a no-brainer to try something. So we built everything in a way that was basically no cost, right, to these brands, unless they were able to get in front of a member who was going to convert and be the kind of member they would have spent a lot more money to go and acquire using paid acquisition or direct mail or however they go and acquire customers. So frankly, we had a very good pitch. We had a beautiful, beautiful product. brand experience that people got very excited about. I think that is often underrated, And then we had very compelling partnerships and salespeople with deep experience in the space. Our partnerships lead was ex-Amex. She basically built the Amex Gold Card. And so there was also this element of like real true legitimacy. And then I also knew the space deeply as somebody who had been sort of at the epicenter of it for 10 years. That also like plays a role, people kind of took me seriously too. And so me and our partnerships team, I think we were like kind of a great tag team. Mara, who ran it, is extraordinary. And we were able to honestly land like some pretty extraordinary deals. See, we had to get kind of creative with some of them. You need a couple kind of key features to stand out as a credit card. And I really think like it was the brands that helped us. But it was work. It was not easy. We were hoping it was just the beginning. Once you have a lot of members or enough members and good numbers, I think honestly, we could have partnered with anyone in the space.
Yeah.
We were in talks with, basically the 10 most interesting health and wellness brands that everyone has heard of as we were approaching our no annual fee second card.
Let's talk a little bit about acquisition costs. Did those come in where you expected, or were those tougher to realize?
So, our CAC numbers were pretty good, but it wasn't a perfect test. Our largest investment in the beginning was actually in influencer marketing. We believed people would would sign up for a credit card. The likeliest way for these members to sign up for a credit card was going to be to hear about this credit card from someone that they already followed and trusted in health and wellness. And so that was our biggest investment. That's really hard to measure the ROI and CAC on that. We also got very scared as we were frankly approaching, in the early 2023, we were launching the card. We kind of saw that the market was really shifting. And instead of putting the money that we were hoping to raise a big round of money and then really put the capital into promoting the card, we started to get very scared. And so we did all the same channels. We had the most effective channel is my favorite channel always, which is content. We had created a wire cutter for health and wellness products and services that was getting about 100,000 unique visitors a month, totally organically. That was the best ROI channel. We had this influencer channel that we partnered the biggest partner of ours was Jonathan Van Ness. Just coincidentally, his last name is Ness. We thought that was really fun. And I don't know, we managed to convince him to come on board. He had a very big following. Melissa Urban from Whole30. We had I think 30 in this program that we had created called our Legends. And so, they were promoting the card and that was working, but it's kind of a long-term, it's harder to sort of judge on the CAC. And then we also did some normal paid spend and that all landed where we thought it would land. But it was just the very beginning. And then we kind of pulled back a lot of it. But what we saw was that the CAC was within where we were hoping to be, a few hundred for a card that cost $399 in an annual fee. And then what we saw pretty quickly was that the people who did sign up, the average spend was well over $2,000 a month. And that was what we were hoping for. That's the dream, right? The dream is that people actually move their primary lifestyle spend to the card. That just turned out to be true. We were just right about that. The people wanted to use this beautiful card. They rewarded them meaningfully for their health and wellness purchases and also willing to put a lot of other spend on the card because of the experience, because of the customer service, because of the brands associated with it. And so all that felt like we were really getting all that part right, at least. But I don't think ultimately on the CAC, we were able to do a perfect test. And by the time that we were kind of in market trying to fundraise, that it was looking not very likely, trying very hard to preserve cash all of a sudden,
Yeah. So talk to me about that experience. It sounds like you went out to raise another round. The interest wasn't there. When did you reach the point where you said it's time to shut down? And how did you get through that process with the board and with the original investors?
Yeah. Well, first, I just want to it's been about 6 months since we formally shut down. And I frankly haven't talked a lot about it, so it's nice and cathartic to actually talk about it because frankly, it's heartbreaking. It's heartbreaking. Look, nobody should cry for a venture capital founder that raised a ton of money and spent it and to build something cool and it didn't work. Okay. So I'm not asking for any pity, but from a personal perspective, I convinced all these extraordinary people to spend, 2 or 3 years of their lives building this really special product, deeply dependent on the financing, partners. And I spent 2 to 3 years of my own personal life. I have 2 young girls now, my family's time to build this special thing. And it is, heartbreaking, disappointing that the thing you built just isn't the right thing anymore. Like you can control so many things. I think we did so many things right, frankly. Look, there was a lot of things, we can get into that, all the things I think I did wrong. But I think we did a lot of things right. And in a normal financing environment, I think we would have had no problem at raising a lot of more money to like give that a try, truly. But it was not a normal financing environment. The timing in some ways couldn't have been worse. We were supposed to launch the card in early 2023. In 2022, the entire market fell apart.
Yep.
In early 2023, nobody wanted to invest in anything, much less $50, $100 million in a capital-intensive fintech business. We kind of knew that was going to be the case. Like I remember, we're hoping all it takes is one,
Sure.
check to for the rest to come together. And we were trying to find the right balance, to be frank, between, how much do you say, hey, we're going to go all out in a sprint and continue down our path in the hopes of finding the one investor that will, buy into this, versus pivot, shift what you're doing and try to do something else before you run out of capital, essentially. And I think we were very mature about those decisions. We were very thoughtful. We had two basically like rounds of layoffs, essentially. One was where the whole team got together. We decided we were just going to keep trying to build what we were building. And we continued to gather data, but do it with like the minimal amount of people necessary. People volunteered to like step off. It was pretty extraordinary, honestly.
Yeah.
Still, tough. But it was kind of like, look, we need to be a lot leaner to really like get into the conversation. And then when that was not working, we cut the team to be much more lean and started to talk about how we can pivot into something else. And we actually got pretty far down the path of pivoting the business away from being so consumer focused into being B2B focused. Maybe not a shocker, but we started to pitch all these insurance companies on becoming their co-branded cards. So the idea being that, yes, these insurance companies might not care about using their money to increase your long-term health and wellness success, but they would totally love to offer you perks and benefits from these brands. Plus, HSA dollars and other benefit utilization is something they want people to do. And so we actually got pretty far with 4 insurance companies you all would have heard of, including one who actually committed to leading a round of capital in us. This was it. Like our Hail Mary was working, and we were going to make it, and then at the last minute, basically they pulled out, and it was over. I mean, we had they knew we had nearly no money left. It was a strategic, like corporate decision. It wasn't the people we were working with. They really wanted to do it. It just felt like the rug was pulled out from under us after a really tough go of trying to make things work. And it was a real bummer, and then the problem with a credit card is you can't just like sell it off in parts.
Right.
Because you've got a bunch of people who were using it. And our bank had to step up in a really tough situation where there was a lot of stuff that happened. Basically, our primary debtor, the person who was underwriting all the people's receivables, took over the business and seized all of our assets to try and recover things. Again, it was a weird market at the time. And so we had no more assets left. Basically, the minute this big partner pulled out, everyone started to vultures came and tried to grab as much as they can. People who were frankly left with the worst part of the hand that was dealt were my team and me. I was okay, but my team and also the bank, who had to step up and try to make the best for members that are ultimately theirs. And they really did. I mean, we were lucky enough to work with a partner we loved.
Who was that?
The Bank of Missouri.
Mm-hmm.
I couldn't recommend them more highly. They were an extraordinary partner to us. And it ended in a way that I think was really unfair to them, basically. And I'm very sorry about that. And truly, in the sense of I'm deeply personally very sorry about that, because I don't think they deserved it. And then, we're all left trying to shut down the business and pick up all the pieces. And that was scary and strange, but ultimately an extraordinary learning experience. But it is what happens when you go all out and you swing big and you miss.
Yeah. You mentioned that you grew a mustache as part of your emotional coping and taking control again. So other than growing a mustache, what are you up to now?
That's mostly, I'm spending most of my time focused on the mustache, Shawn.
It's worth it.
Yeah.
It's showing.
Along the way, people forget about this, but like that was my job, was the startup. And believe it or not, my wife did not want me to jump right into starting another company. And plus, you have a lot of like emotional, it's a very emotional process. There's a people part, there's a vision part. Like it's, I'm still mourning really the loss of Ness, which I think in a different timing, in a different situation, could have been all the things that I had hoped it would be. I think we were ultimately right about our vision. And I don't regret the approach we took. Again, there are many things I would have done differently, and I take responsibility for the outcome. Ultimately, it's like on me and my shoulders, but it's hard and it's heavy. And I was not ready to like go do something, after that. Plus, I'm still winding some parts down. And so I fell into doing what I had done in between my first company and Ness, which was consulting. Along the way, over the years, I've become sort of this, frankly, like full stack health and healthcare marketer. I've basically done every type of marketing. And whether that's, like out of home advertising on vans in rural areas, or whether that's direct mail, I've basically done everything now. And a bunch of friends who run healthcare companies asked me for help. And so I've been mostly working with a bunch of different, all very, very exciting, 5 or 6 amazing health and healthcare startups to help them go to market. That's been taking up my time for now. And frankly, it's been a nice change of pace. I'm making more money from that than I made from Ness, believe it or not.
That's how that works.
Which isn't hard to say. But I'm excited to get back into the fray, frankly. I'm probably going to need a little bit more time. Last time it took me 18 months. I think this has not changed any way that I perceive. It's not changed my confidence about and excitement to try and swing big again and work on that mission that we started with, that I feel deeply about, which is making health and wellness more accessible and affordable for more people. I think that's never been more important than it is today, and I've never thought there are more opportunities, especially with generative AI and some of these like really exciting trends. I think there's a lot of really exciting stuff going on right now. I'm just trying to help and support where I can, but I'm excited to get back in the mix again in the future.
So as a final question, I want to ask you, what lessons will you take into that future role?
Yeah. I think there's a lot of value into seeing things work and not work. Sometimes when things work, you start pretending like you're so great and you were right all along. It's very humbling to think you were right a lot and still turn out wrong.
Yep.
I think a few things. First, I don't think ultimately I appreciated how difficult the credit card model was. Frankly, I know that sounds so silly or stupid in some ways, but you have to understand I had like every smart person in the room, with me. And I'd like to think I'm plenty smart too and understood the model very well, but it's a very tough model, a model that I wouldn't recommend anyone, frankly, try to take on without a business that is working so well already that you can fund it for many years and have a consumer base to start it with, or extraordinary partnership or backing in terms of capital or like a bank partner. I don't think consumer driven. I think Built is a very odd exception.
Yes.
That basically got all the timing right. Again, I think Ankur and that team have done a pretty amazing job, but they basically got lucky. From my perspective, I think their timing was really right? They were able to build, a year or two before us. They were able to build enough to get Wells Fargo to partner with them at a moment in time that was very unique to them. Wells Fargo, I'm blown away by what they've done, but there's no other examples that I can think of. And in fact, if you need any proof that consumer cards are hard, look at Apple Card, where the Goldman Sachs trying to get rid of it. I think that was the wrong path to take, frankly. And in retrospect, that was probably me just being stubborn and feeling like it could work, feeling like I could raise the capital to make it work. But ultimately, I think to have seen through and accomplished our mission, we probably should have, frankly, taken another different form factor. I think one tied to fintech, but probably not in the form factor of such a capital intensive, such an odds stacked against you situation. That's a big learning. I think we did a lot right. The team was extraordinary. We probably should have pivoted sooner. We were hoping that the market would change. I think we knew what the kind of business we had and the response that we would have. And so we kind of, again, maybe this was stubbornness, this is one of those things you do the Hail Mary and you hope that it, the guy catches it at the end. We probably should have reacted quicker to the market changing, been a little less frankly, optimistic about it shifting and improving, and instead kind of taken quicker, more decisive action.
Right.
In a way that would have allowed us more time to pivot into a different model and potentially have, saved the business. Again, hindsight is 20/20, but I do think like the timing is something that is very hard to predict. And there were as many people saying it's going to be like this for 10 years as there were people saying, I think it'll be better in 6 months. And so we chose to assume it might be better in 6 months, and we were wrong. Right.
Yeah.
So again, that's the way it works. But I don't feel like I made any mistakes around the people that I partnered with. Frankly, anybody, the people we hired and the people on my team, best in class. Our investors, extraordinary. Every one of them, amazing. So like supportive and understanding at a time when like this was a loss for many. I mean, all of them, but also like, it's like not easy, right? When you make these bets, but they felt like we communicated, we took their opinion, we listened to them, and a lot of them really helped along the way. I'm sorry it didn't turn out the way it should have, but and then even our partners around, whether you talk about the merchant partners or you talk about the partners across the credit card stack, really, I think we worked with best-in-class people and best-in-class partners. And so, it's about piloting the ship too in the right direction.
Yeah. And it's a roll of the dice at some point. Well, thank you so much for sharing your experience. Yeah, I think everybody loves to talk about the wins. Everybody loves to make a 8-part series on the dramatic failures, the FTXs, the Theranoses. Yeah. But listen, we all know that there are more failures in this space than there are successes. And I really appreciate you opening up. I guess if you got some catharsis out of this, that's a win for all of us.
Yeah.
All right. You can follow Ensemble X and Derek Flanzraich. That's DEREK FLANZRAICH on LinkedIn. You can also visit us at ensemblex.com, and you can find the Ensemble X Exchange podcast on all major platforms. Thank you for listening.